Audit has been in the present for many years for now. It started in mid 18th century. But how we conduct an audit has been evolving every now and then with the advancement of technology, coming of various laws. And now one of the laws which we are talking today is how auditor will wear a lens of AML while conducting an audit of a financial statement or other internal audit or due diligence audit or any of the assurance assignments. It will be worthwhile that ISA International Standards on Auditing 250 gives or requires auditor to consider the laws and regulation in an audit of a financial statement. And non-compliance with laws and regulation, that duty has been cast on auditor. Which laws to be considered, which are having a material impact on the financial statement figures or disclosures in financial statement. So it is a requirement of international standards on auditing that we are complying with the various laws. And if are not complied, we need to take appropriate action, maybe qualification or whatever. Having understood that, because that is a requirement, and non-compliance, as Phillips G explained, and last, the cost of non-compliance you cannot just take. And sometimes, as they say, it is better to be safe than to be sorry. So we need to take non-compliance of the law very, very significantly. And international standards on auditing requires you to take it up to a level of whether it have an impact on the going concern of an entity. To that extent, ISA is requiring us to take this into consideration. So non-compliance of the law is very, very important. Having understood that, let us take into consideration from an AML angle. We are talking today only on AML, so we'll take from AML angle what things needs to be considered while conducting an audit. It will be worthwhile to know that trade-based money laundering is very, very pertinent. And FATF in June 2006 came out with the booklet on the trade-based money laundering. And International Chamber of Commerce in 2018 called trade-based money laundering the least understood financial crime method, and estimated that hundreds of billions of US pass through trade-based money laundering schemes each year. So you see the impact, and what is that? Having understood that, the first and foremost, as Asna also covered during her presentation, the first and foremost is proper understanding of the nature of business which is carried on by entity. ISA 315. We need to be very clear on nature of business which is conducted or carried on by the business client. So knowledge of client business is very, very important. Business, which are the business activities which the client is carrying on. Whether they have a necessary knowledge to carry out that kind of business activity. A person will say, I am a jewelry trader or rough diamond trader, and he himself does not know anything of gem and jewelry. And they have not appointed anybody else who is expert on this field. The first question should come to our mind as an auditor is whether he can carry out such kind of business. Where you don't know the main requirement to carry out audit. So that should be one of the major red flags. So this is one, as Asna ji has already covered, major customer standard due diligence requirement. So we should know the major customers of the client, their location, geographical locations. And this is required at the time of doing the, as I call it, permanent file build-up. These are the questions at the time of permanent file build-up, which you should do. Major customer, their location. If there were certain previous auditor, then look into the disclosures which they have given, maybe for country risk disclosure of trade receivables. So that will give you an idea where their customers are located. Then even segment reporting under IFRS 8, if that is being given and disclosed, read with IFRS 15, that will give you what are the sales constitution in the various jurisdiction of the countries. So that will give you whether the company is dealing with high risk jurisdiction. This will also give, as Philip also covered in his presentation, whether the payment should come from which countries, because I am dealing with that countries. Then I should be receiving payment from that countries and not from somebody else or somewhere else, because that could be one of the red flags from AML's perspective. Who are the major suppliers? That we should be very clear, because there are a thin number of fraud in the supply chain, this thing also, where the quantity which is mentioned, that is not correct. Goods are misrepresented on the letter of credit. Shipment may include prohibited goods. The value of shipped good is inaccurate. So these are the supply chain consideration which an auditor should also consider. Then what are the, when you go for a next year, last year we conducted audit, this is the second year of our audit, we should also ask what are the new market which the client has started, new customers which they have got, new business activities which they have started, new suppliers which they have started. See, these are, as I always say, asking right information at right time and in right manner is of paramount importance while conduct of an audit. And this is very, very important from AML's perspective as well. And correlate this information which you have gathered at the inception of the audit with the actual conduct of the business. So this is one aspect. Then coming to the audit proper, doing thorough ledger scrutiny is of paramount importance. Ledger scrutiny will give you many red flags or some ideas what is going or suspected to be going wrong or where we are supposed to check. Thorough review of cash account. As both the speakers have explained, that cash is very important area which we as an auditor needs to give due importance. Cash account review is very important. However, in certain cases, the entries which are there in the cash, but they are not routed through cash account. Creative accounting, as I always call it. Bank, if the payment has been received from the customer or third party, and we are depositing cash into the bank. In that scenario, the entry passed by the book accountants are bank account debit to party account credit. And sometimes auditor is misguided. This is a bank receipt. If you go and check the bank statement, it will say cash deposit. And these are the very important area which needs to be looked into by auditor. And that is the very one important thing is that there is a bank statement review which needs to be conducted. We do checking of bank payment, bank receipt, maybe a statistical sampling method or judgmental sampling method. The question is, and for that account or that receipts or that payment, we check bank receipt, or for the purchase payment or sales receipt. Question is, we need to look into the bank statement properly. And as Asna ji was mentioning, understand the transactions from the bank statements. So this is the point which I am clearing. That going through the bank account, bank statement is very important, and narration in the bank account is also very important. That will give you, as I told you, we need to know major customer, major supplier, and Philip also covered in his presentation that payment coming from third party. Repeatedly we see the payments are coming from, say, a company registered in tax haven countries or BVI or whatever. So that should be a red flag which should come to our mind. Why? I'm not selling anything to BVI, but payment is coming from BVI or Cayman Island or offshore entities. Why the payment is coming from that? This needs to be looked into and analyzed. Thorough scrutiny of trade receivable account, and due importance to be given in journal entries which are passed in trade receivable accounts, because that will give you a classic case where the payment is received in from company A on behalf of company B. So then JV will be passed. That should give you an idea or indication why this kind of JVs are passed in the trade receivable account. Very important is a moment trial balance review. What I mean by moment trial balance review is, for the complete period under audit, there is opening balance, debit during the year, credit during the year, and closing balance. And please be careful to include zero balances in this moment trial balance review, because there may be a scenarios where all these accounts where something has happened, or their year-end balance may be zero, and that will not come in the moment trial balance report if you have not taken that report with the zero balance required. In that, once again, you can get cash account. What is the debit during the year in cash account? What is the credit during the year in cash account? That should also give you a value. What is the value of transaction being routed through or going through the cash? Second important is a bank account. There are 3 banks account in the company, and sales of the company is 100 million, but the credit in that 3 banks account, total credit for the year in that bank account is 400 million, 4 times the annual turnover of the company. Now this should be one of the red flags, that why we are having such a huge difference between what is annual turnover and the credits in the bank account. This could be on various accounts, maybe the earlier year collection from debtors, contra entry for fund transfer between the accounts, and loan transactions or funding transactions. So which are that funding transaction which have been routed through? And there could be a vice versa situation which we have already encountered, where the sales of the company was, an example, 500 million, but the total receipts in the bank account was only 100 million. So only 20% of the sales are there, and 80% is not that they are represented by way of a trade receivables at the year end. But what was being told to us, that we have a tri-party agreement, the payments are being received by that other party, and that is the reason why the banks, the funds coming in the company's bank account are only 20% of the annual sales. Now there, if you read IFRS 15 properly, it will not allow you to go through such a kind of scenario. So we need to be very, very careful during this moment trial balance review. Another thing is frequent change of business activities. As we say, how a normal businessman will frequently change his business activities from jewelry to fertilizer trading, then general trading. So whether management has a sufficient knowledge of that kind of business and why the business are undergoing change periodically, that should be one of the red flags. There have been cases where there is increase in share capital within short span of incorporation of a company. It can be genuine, very much genuine also, but certain cases it is as Philip also said and everybody, that it is a red flag. We need to look beyond that. What are the source of funds which are being introduced as an additional share capital? Share capital was, say for example, 300,000 at the time of incorporation of a company, and before the close of the first year it was 5 million. Before close of second year it was 15 million. It was a practical case. It was requirement of business requirement, and the funds have been transferred by parent company to the subsidiary company for making investment in step down subsidiaries. Fine, as long as we are very clear on the source of funds, their deployment, the funds coming, if it was a country like India, coming through overseas direct investment route, ODI route, FEMA compliant, then nothing to worry. But this should be a one cause, because there can be a situation where there could be a money laundering involved because of the increase in share capital very rapidly. Loan agreement. Now, these are the another area where you have a loan from an unrelated party, that is not a related party. AED 100 million loan given. They are not the financial institution. They are not in a business of lending money. They are not our related party. Or maybe they are related party, but the client is informing to us, no, that is not my related party. The question arises whether there is red flag, whether there is AML angle into this, and no collateral security is given as per the loan agreement also. So it does not make a business sense, business logic, commercial rationale for such loans to be received. This needs to be inquired. One more thing which has been come to our mind could be a closure of bank's account within the short period of time. Bank accounts are open, some transaction takes place, and within 8 months that bank account is closed. Normally, no business will usually close bank account frequently. So that needs to be inquired upon. We have already covered payment received from high risk geographical location, unusual party, that needs to be looked into. Transaction which involves offshore countries or tax haven countries needs to be looked into very properly. Another is sudden increase in business, maybe volume or value, both. So that whether it is genuine, whether actual movement of goods have taken place, or it is only a movement of invoices and funds without actual movement of goods. There could be reverse, unexplained period of dormancy in business. That needs to be questioned as well. That business was dormant for almost 2-3 years, and suddenly it has started with a rapid increase in the business activity. Discrepancy between bills of lading and invoice, that needs to be looked into as well. When we are looking at the sales, shipment location is different from the what is mentioned in letter of credit. That also, and if it is becoming frequent during our verification of sales transaction, this also needs to be looked into. Very prevalent in this part of the world, switch BLs. Extra care needs to be taken because exact port of loading, country of origin may be altered because of the switch BLs. One very, very important thing which has come very long back, significant related party transaction. Buyer is also a related party. Supplier is also a related party. Shipping company and logistic company are also related parties. They are only third port shipments, huge bank facilities, proper documentation, only LC and invoice and bills of ladings are being moved. Falsely declared goods in bills of lading. This was already found out. But this should be an area, and banks have lost money in this kind of scenarios as well. And we should be very careful in such a type of transaction. Significant consultancy payments being done. We need to check whether that company which is receiving consultancy payment, check on Google, whether they have a presence on Google, their website, whether they are, how many peoples are there, because that it may be a just SPV, special purpose vehicle, and just we are going on giving the consultancy payments. Significant commission expenses, whether this is requirement for the nature of business which the company is carrying on. Loans to related party. What are the source of funds obtained to give such interest-free loans? We need to be very clear, because sometimes the funds may come given to related party, but whether they are all from legitimate means, source of wealth, source of funds are very clear. As Joseph also covered, Philip also covered that significant write-back of loan received and significant write-off of loans given. These are also an red flag area which we should cover. One more thing which came to our this thing during the course of our audit sometimes, and creative accounting, suppliers account debit to TR account. This is a very normal accounting entry. But supplier account having payment to supplier by trust receipt is not an unusual transaction. But looking at the ledger scrutiny of supplier account, there was no purchase from that party. So if there is no purchase from the party, but you have taken TR, and when we questioned, the answer was, we have a TR facility for this parties, X, Y, Z parties. And now I have imported goods from A party, which is not approved by my bankers. So I am opening TR on Y party. So all this thing needs to be looked into, and there could be a red flags which may come during the course of audit. Then compensation for non-performance of contract by supplier. This is another thing which is going on. 1 million compensation received because the supplier did not perform under the contract. It can be genuine. I am not disputing that. But we then need to look into how many transactions or purchases we did from that party. Whether it is a regular. We did say 80 transactions during the year and one transaction could not be completed. And yes, as per the business sense, we have received non-performance compensation, fine. But there is only one contract with the party and there is a non-performance and party is paying you compensation. I am not saying this could not be correct or this should not be but this should at least trigger a red flag during the course of our audit. Similarly, forfeiture of advance received from customer, cancellation of orders. So how many orders we have executed with that customers? Only one, and that also forfeited, amount received as advance taken to income. All these things. So business sense, commercial rationale needs to be, whether it is logical, that needs to be looked into during the course of audit. Friends, this may be, while there are several indications identified, which does not appear to have a direct or exclusive connection with trade-based money laundering and may be indicative of other forms of money laundering or other illicit activity, they may nonetheless be relevant when trying to identify trade-based money laundering. This, whatever I have narrated situation which we have come across or visualized, they may give a red flags, or we, during the conduct of an audit, we need to look into all these areas, and if the situation comes, we need to take appropriate actions. Now, as an auditor, usually we ask various reconciliations, maybe whatever the VAT returns files, excise return files, along with what is there in audited financial sales reported as per audited financial statements, or import box 6 reconciliation, etc., etc. There could be many reasons, but today we are discussing only from AML perspective. What could be the reasons for a difference between what is reported in the VAT returns quarterly or monthly and the sales figure or input tax figures which they have done credited. So there could be many, but today from AML angle, some of the things which comes to my mind are we need to look into whether there are cases of over invoicing of the goods, under invoicing of the goods, multiple invoices for same goods or services, fraudulent invoicing for non-existing goods or services, overshipment of goods, undershipment of goods. These are some of the areas where or reasons which we need to be considered. And friends, UAE guidance to the auditor, UAE authority guidance to auditors specifically covers that this needs to be looked into by an auditor during the course of audit, that all this may lead to their AML this thing, and we need to report or take cognizance of it. Now, taking one more example, that company A is the electronic traders. They are trading with one of the sanctioned countries. The question arises, and electronic goods, so therefore there are dual use goods. So we need to be very careful, because the TVs or microwave oven, everybody have separate IMER numbers, serial numbers, and if they are used in sanctioned countries for weapon of mass destruction, etc., etc., then we need to be very careful how our client knows actual end user and actual end use of the goods which we are trading. They are trading, not we are trading. They are trading. So if that is not clear, this is a very, very significant AML risk which we should look into. Similarly, another commodity could be a fertilizer, which you have already seen. Ammonium nitrate stored at port of Beirut, which was, last Beirut blasts were happened. So, there can be a fertilizer, electronic goods. They are all, and there are many umpteen number of dual use goods. So whether this dual use goods, so unless our client is very clear of and use of the products which they are selling and use of the party which will be selling, that should be taken care. Hiding and obscuring the types of cargo during such a transaction, which we very to be looked into. Second, coming to the documentation aspect, particularly of this kind of transaction, fake or tempered documentation may be provided to us. We need to be very careful on this aspect. Altering or misrepresenting the port of loading or port of discharge on bills of lading will be there. Payment is received in cash. No proper external evidence is there in support of receipt of such huge amount of cash. Cash is deposited into the bank. Entry in books of account, as I already told before also, bank account debit to party account credit. So if you don't look it properly, you will always feel it is a bank transaction and not a cash transaction which is deposited into the bank. Cash account, there are no entry at all. We need to be very careful at the time of scrutiny of bank statement. What is the narration which is coming for such entries in the bank statement? Sometimes routing of payment via an unconnected third party who has no apparent commercial involvement or interest in the transaction. So this could be also one of the red flags during such a transaction which we should be looking into during the course of our audit. Some of the key rules which we need to follow during our audit: know your customer, detect red flags, sanction screen every major transaction, know goods involved in each we cannot be in each transaction, but at least which you have selected for your audit sample. So know their goods, know the end use of that good, know the end user, know the destination country, verify if the license is required to trade in that kind of commodity. Like in rough diamonds, you have a KP license will be required, KP numbers are there, whether that is there or that is not there. That will be the one major trigger point for AML. And one more last thing which comes to my mind, that we will ask all these questions during the course of our audit to our clients. And majority of our clients, they are not DNFPB. So they are non-DNFPB. So whether they will be what care, precaution which they need to take care, whether it is in our interest to educate our clients. See, AML law is saying if you raise an STR, you need not report to your client. But giving knowledge to a client that what you should take care, that is not prohibited by law. And we need to be very clear, because suppose the client is doing into cash business, he needs to inquire the source of funds which that customer or walk-in customer is having. And then they need to take necessary steps, because when they will go to bank for depositing such cash into bank will question them from where they have got, whether it has, and many a time you will all agree, now even we cannot carry currency, so much of currency, bag full of currency and travel. And anybody is saying that I came with bag full of currency and now I'm giving that currency to you. Whether the declaration at the Dubai airport or whichever airport he came was done, that declaration is there. All that thing needs to be, we need to educate our client. When they are saying where their customer are requesting so many changes in the letter of credit at fag end, even beneficiaries are changed at the fag end of the LC transactions. All these are the red flags which the client needs to look into. We need to educate our client. Avoid, we need, when customer is saying accept cash or on my behalf, somebody else will make the payment. This should be, customers, our clients should ask why such kind of arrangement you are requesting me to do. So these are the some of the things which non-FPB people also need take into consideration. Some of the companies have started screening of person or company before dealing with them, maybe as a requirement of their head office or parent company in a very strong jurisdiction. But these are all requirements which needs to be taken care of. Thank you very much for giving me an opportunity to sharing my views and my observation on the subject.